Hi, my name is Tom Straub, publisher of the Stop Foreclosure Kit. You know, it's possible you've always paid your bills on time and you've never made a late payment on anything in your life. Then the recession hit. Now you've been forced to make choices between buying food for the kids or paying for your mortgage. Well, it's obvious you won't starve your own family. Don't worry, the law provides a mechanism that mortgage companies must obey, known as the foreclosure process. In addition, there are many legal and ethical mortgage alternatives that are available to you. In this short video, you'll discover how you can keep your integrity solid by knowing just how much home you can really afford and the pros and cons of home equity loans. In your mind's eye, you probably have a vision of the perfect home. It may be a two-story, it may be a ranch, it may have a brick exterior, or it may have aluminum siding. It may have French doors and decorative window seats. It may even have several fireplaces and ornate crown molding. You have to realize, however, that even if you intend to occupy the dwelling for 30 years or more, you still need to be realistic. It's entirely possible that although you may not be able to finance your ideal, you can still afford a house that meets your needs. Being realistic in your home shopping can help you avoid the type of home that's likely to lead to foreclosure. A good rule of thumb is to figure that your entire house payment, which includes the principal, interest, taxes, and insurance, should run between 28 to 30% of your actual net income. That way, you should have plenty of money left to spend on your other needs, including home maintenance costs and utility bills. In fact, the ancillary costs associated with home ownership will probably run you double your monthly mortgage payment. This is a cost that renters often fail to consider when they make the decision to buy a home. However, before you make an offer, you should carefully consider whether you can afford all of the costs that a home of your own entails. Another way to calculate the costs is to figure that you should not buy a house greater than 2.5 times your current income. Do not, under any circumstances, borrow money based upon income that you hope to make. Reality may not meet your expectation, and you could suffer really painful financial consequences as a result. In fact, buying a house when you're not ready is considered the top financial stress in many marriages. When you're shopping for a loan, it's a good idea to interview a couple of different lenders in order to find the one that's most likely to give you a great deal. If you feel as if the lender is not being upfront with you, or you find it difficult to understand what he or she is trying to communicate, move on. Of course, interest rate is a primary consideration when shopping for a loan, but there's other cost factors involved as well. Be sure that you know all the fees that are connected with a loan before becoming pre-approved. That way, you'll have a clear understanding of your financial burden before you sign on the dotted line. In order to make the right offer for a house, there are a number of questions you'll need to answer to determine what your offer should be for a house. Some questions you might consider are, how does the house's asking price correspond with house values in the neighborhood? Does the house have obvious maintenance problems that would affect its value? Are the houses on either side of the home in good condition? Does the home have curb appeal, or is it a fixer-upper? Do home sellers in the area generally get their asking price? Does your realtor consider the current real estate market to be a buyer's market or a seller's market? And notice this applies to the local market. How much can you realistically afford to spend on a mortgage? And finally, do you expect the home seller to make a counteroffer? Once you've determined the answers to these questions, you're going to be well on your way to making the correct offer for the home that you desire. You'll want to do everything possible to cut mortgage costs over the long term. With a little planning, you can potentially save thousands of dollars for the duration of your loan. Keep in mind that your largest expense will be interest. As a result, you might want to prudently utilize discount points to lower your interest rate. If you make a large payment at closing, you can bring down your interest rate quite a bit, but even paying a small amount can result in cost savings in terms of your interest. Be sure to request a rate sheet from your lender in order to find out about the various rate fee opportunities that are available. The amount of your down payment will have substantial effect on your interest expense. For instance, if you choose to make a large down payment, you'll be borrowing less money, and as a result you'll face a smaller interest rate. For the most part, lenders require home buyers to purchase private mortgage insurance until the balance of your loan is 80% of the house's fair market value. When you enlarge your down payment amount, you'll reduce your PMI expense more quickly. Of course, if you opt to make a significant down payment, it means that you'll face higher closing costs. Do some quick math and determine whether the savings you'll have over the long haul is worth the upfront cost. In case you're not familiar with the concept, prepayments are excess payments on home loans. With a prepayment, you'll be cutting the loan duration and interest expense. The more you put out in terms of a prepayment, the higher the savings. Consider consulting the World Wide Web for an online prepayment mortgage calculator. The calculation will enable you to figure out how much your loan duration and interest expense will be cut through prepayment. You have the option of whether or not to include a prepayment penalty clause in your mortgage contract. Before you make your decision, you should consider the fact that prepayment penalties are generally only assessed if you sell or refinance during the first few years of your mortgage. Also, loans with prepayment penalties often have lower interest rates than those with such penalties. As a result, if you don't plan to resell or refinance early in your loan, it's best to accept a prepayment penalty clause. That way you can secure a lower interest rate for the life of your loan. It is also important to keep in mind that there are various other expenses that you'll encounter at closing. For instance, you'll have to pay legal fees, document fees, and recording fees. However, when you factor in the interest cost, these expenses only really comprise only a small portion of your total cost. Be aware of the fact that some lenders advertise low settlement fees, but end up penalizing buyers with high interest rates and mortgage costs. Rather than focusing on individual fees, find out the bottom line. If your total mortgage has a lower cost, be willing to accept higher closing fees. You'll be saving money in the long run. Fortunately, the Federal Reserve is offering some sage advice for homeowners who find themselves in need of extra cash. In many cases, such homeowners turn to home equity loans for relief. But as the Federal Reserve points out, not all lenders are created equal. That means that comparison shopping is absolutely vital to ensuring that you get a high-quality deal. If you contract with a lender who is not on the up and up, you could find yourself burdened with a high-cost loan which could jeopardize your home ownership. Such lenders often prey upon people with low incomes, individuals with troubled credit histories, and senior citizens. They may trick the homeowners into agreeing to a deal with deceptive loan terms or extend them loans that they really have no hope of ever repaying. The first order of business, according to the Federal Reserve, is to carefully consider your various options. For instance, if you're facing financial problems, discuss the situation with a credit counseling agency. The agency may be able to work out a payment plan for you that will enable you to avoid bankruptcy and will help you free up the money you need to make your monthly home loan payments. Next, consider contacting your church or local community group that offers consumer protection programs. You may find that the group can give you money for your utility bills, home repairs, food, and other emergency expenses. If you're an older American or an American with a disability, you may be eligible for special assistance. You should be aware of the fact that if you obtain a home equity loan and you fail to keep current on your payments, the lender may foreclose, causing you to lose your home. To avoid such a situation, you should give careful thought to whether a home equity loan is actually necessary in your particular case. If there's any way to meet your financial obligations without one, that may be the route to take. If, after considering all your options, you decide that a home equity loan is in order, be sure to speak with a variety of lenders, including at least one savings and loan and one credit union. You may find that these entities offer lower cost loans than finance companies do. Fortunately, you may be able to qualify for a loan even if you've had credit problems or you're on a fixed income. You might be surprised by the variety of loans that are available today. Be sure to talk with friends and family members to see if they can offer recommendations for you. It's possible that a close friend or relative has already refinanced his or her house and knows the best deals available in your particular area of the country. The Federal Reserve recommends steering clear of loans offered by home repair companies. You're far better off obtaining a loan yourself from a financial institution than spending money on home repairs. Home repair companies that offer special financing should be avoided if at all possible.